Let's talk money.
Hello and welcome to another episode of Let's Talk Money. This is our third episode and I'm your host, Surabhi Upadhyay. This, of course, is your one-stop destination for all the personal finance queries that you may have. You ask and we answer. That's how it works. Now, over the last couple of days, a lot of you have been writing into us to discuss issues around passive funds. Whether you should invest in them, and if so, in what proportion, what kind of passive funds, considering we have passives on almost every and anything, all kinds of indices, all kinds of themes. So we're going to be taking up a lot of these questions today, and joining me on the show to help us unravel a lot of these queries and get the answers is Ashish Shanker, who's the MD and CEO of Motilal Oswal Private Wealth. Ashish, so good to have you in the studio.
Same here. Very
Thank you so much for taking out the time. Please come, let's have you here. So Ashish, as I said, this is a show where we are really driven by what people want to know, and what they seem to want more clarity on is this whole debate between active versus passive, which I know is nothing new to you because we keep talking about it. So why don't you share some first thoughts?
So I'm really glad you took up this topic because it's such a raging debate. And if you look at the West, in the US, passives are the biggest category. Because over time, what happens is as the markets mature, the possibility of generating alpha goes down. However, I do believe that in India, we are still emerging, right? I mean, there is still underpenetration as far as equities is concerned. Mutual funds as a product is just coming of age. So there are enough opportunities to generate alpha. Having said that, but I do believe that every portfolio can have some passive allocation, especially, we are very bullish on the large cap passive space because it's very difficult now to generate alpha continuously. And we are seeing that in the numbers as well. Very few large cap funds are able to generate alpha consistently.
Okay, fair point, and we'll talk about this as we go forward. Viewers, I mean, for those of you who probably are wondering what is this we are talking about, what is this whole passive stuff, just a simple definition. Passive funds essentially are funds where there's no human fund manager deciding and picking stocks. These are funds that simply replicate an underlying index. The underlying index could be a Nifty 50, it could be a Sensex 30, it could be even the mid-cap index, or it could be a lot of strategy-based indices that the stock exchanges have come up with in the recent past. So we'll talk about all of this as we go forward. So Ashish, with your permission, I'll get started and let's get in the first viewer.
Absolutely.
Okay, let's get to it then. Parag Joshi is joining in from Mumbai. Parag, great to have you on the show. Tell us, how can we help you?
This is Parag Joshi, I'm calling from Mumbai. I had one query regarding this ICICI BHA22 ETF. Actually, there are two queries in short. I just wanted to understand the basic concept of ETF, how it works vis-a-vis a mutual fund, and it's listed as a share in the market. So with my investment done in 2018, when there was a fund-on-fund offer of this particular ETF, so this didn't perform well, and it being a collection of 22 funds with 16 or 19 PSUs and other 3 private companies like L&T and other companies. So it has started performing well since last 1 year. So just wanted to know, since it's being a collection of miscellaneous stocks, I think its performance is based on all the performance of these individual stocks. So how does it move ahead in future? Whether it remains at the same place, it's now trading at 100, or it goes ahead. So should one stay invested in that, or what's the future of this?
Okay. I guess it's no surprise that when you bought into this product in 2018, Mr. Joshi, that time PSU stocks were not doing that well. I mean, they weren't so loved by the market as they are today. So no surprise that you now would be having better returns. I'm sure you're quite happy with what you're seeing. So basically, you've invested in a passive strategy. This is an ETF which follows, as I said, an underlying index which comprises of these 22 PSU stocks. But for us to answer this question properly, for Ashish to give you the right advice, we want to know one thing. A, what is the kind of gain you're sitting on? Whether you have the capacity to hold, do you have any immediate reason to sell and book your profits? And also give us some indication of the rest of your portfolio. Do you have more passive funds? Do you have active funds? How does the rest of your portfolio look like?
Not invested in any other passive fund, madam. And if you can see the returns vis-a-vis my investment, it's more than 30-35% as of now with the current appreciated rate of the fund actually. So I might be holding on or like to book some partial profit, but then it depends. If it's going to further appreciate, then I have the holding capacity.
All right, Mr. Joshi, hang in there. We'll get the advice to you straight away. So there you have it. I think when he bought it, maybe he didn't realize what he was buying. But then, everything has turned to gold ever since in the last 1 year.
Yep.
What would you say?
So very interesting and relevant question. So let me answer it in three parts. His first question on how is ETF different to mutual funds, right? Now, in the mutual fund category, you have active mutual funds, and there are mutual funds which feed into index funds, right?
Yeah.
Now, these are products where you can buy an index on a daily basis from the fund house. You can either subscribe or you can redeem, and you get units against the investment that you make.
Yeah.
An ETF, by definition, is an exchange-traded fund. So the corpus or the holdings are formed one time at the beginning. So this Bharat 22 ETF was formed when the government wanted to divest its holdings in certain public sector enterprises.
Yeah.
Now, instead of going out there in the market and selling to large institutions, they thought it is better that they create a retail vehicle where they put certain companies in certain proportions and create an index basket of public sector enterprises and issue those units to investors,
Right.
so that there is wider participation. So that is how this came into being.
Yeah.
Now, ETFs, the other difference between ETFs and mutual funds is in an ETF, the corpus of the ETF does not change every day because they are traded on the exchange. So it passes from one investor to the other, right? Sometimes when you want to invest a large amount, the fund houses who run these ETFs can also create additional units. But otherwise, by definition, the corpus doesn't change. So I hope the definition of the contours of an ETF are reasonably clear. Coming to this ETF, like you rightly mentioned, this is an ETF formed of public sector enterprises. Typically, if you look at the composition of public sector enterprises in this ETF, they are more linked to the investment sector. Now, our view on the investment sector, which is capital goods, construction, real estate, over the next 5 to 6 years is very, very positive.
Okay.
So I strongly believe that he should continue to hold on to this investment. I mean, he had a bad first 3-4 years, but the last year, this product has done a lot of catch up for him in his portfolio.
Yeah.
And the next 3-4 years look good. The only caveat being that at some point, maybe a year or two down the line, he should reduce the concentration of this product in his overall portfolio, because I also heard him saying that this is almost 35% of his equity portfolio, which is a large concentration to have in one particular fund which has only public sector enterprises.
Sure.
So this is a decision not for today, but maybe a year or two down the line, he could gradually reduce the holding and maybe get it down to 10-15%.
Okay, so Mr. Joshi, whatever made you buy this product, for now it's working really well for you. So hold on and stay there at least for the near future. That's the advice. Let's quickly move to another query. This one is coming in from Vijay Kapadia, who's also a viewer from Mumbai. So let's find out what his question is. Vijay ji, thank you for joining in. Tell us about yourself and, of course, your question.
I'm Vijay Kapadia from Mumbai, and I am holding 3 mutual funds. The first is HDFC Balanced Advantage Fund, which is 70%. The second one is Aditya Birla Sun Life Frontline Equity Fund, which is 20%, and DSP Equity Fund, Opportunity Fund, which is 10%. So I would like to know if I can switch some funds from these 3 mutual funds to some passive funds, equity funds like ETF or something.
So, Mr. Kapadia, before we proceed, it's very important for us to understand why you are looking to switch. One of them is the HDFC Balanced Advantage. You mentioned a DSP fund and one more. Just to understand, do you need the money? Why are you looking to switch from these funds to something else, including maybe passives?
Yeah, these are the 3 funds I am holding, and maybe I'm looking for some better returns. Maybe 2-3 years I can, that's not an issue.
Okay, so you can hold for 2-3 years, but you want maximum returns. Fair enough. Just give us an indication of the rest of your portfolio. Were these the only 3 mutual funds that you were holding? Do you have others? I mean, how much have you invested in equity and maybe in other traditional non-equity instruments?
I've got equity shares also. I'm invested in equities as well.
Okay. Okay, so you had these three funds, plus you were doing direct equity as well. Wants to switch? Maximum returns. Ashish?
Look, the fund that he mentioned, HDFC Balanced Advantage Fund, it's a very old fund with a phenomenal track record. It used to be managed by a legendary fund manager. And it switches between equity and debt, albeit more allocation is towards equity to give the benefit of taxation to the investor. My recommendation, given where markets are, it's a good fund to hold on to. I understand that everybody wants to maximize returns. And at times when markets are doing extremely well, the talk on risk dissipates.
You don't want to be, you know,
Absolutely.
10% giving, downside protection kind of a fund. You just want the upside.
So considering that he's also doing direct stocks, and I'm assuming that he's able to take a little more risk there, it's a good allocation. I feel all the three funds that he mentioned are good funds in his portfolio. He should continue holding. See, this people don't realize the switching cost. I mean, when you redeem, you pay taxation, and then you got to decide another fund to invest in.
Sure.
And there is no guarantee that the next fund is going to do as well as what you've done in the portfolio. I think he's got a good set of funds. He's also doing direct equities. This is a time where he should probably consolidate rather than trying to do some activity.
On the subject of returns, and that's where the debate gets the loudest, right, between active and passive, because people are looking for maximum returns in a thriving bull market right now. Is there any data that really suggests over longer time periods what outperforms? An active managed fund with a human sort of perception and mind to it, or simply mirroring the index? I mean, in all your experience, what stands out?
So that's a very tricky question, but let me attempt to answer it. Look, a market which has reasonable inefficiencies, there is always a possibility to create alpha. But with the kind of information dissemination we are having now, with the diverse set of participants and digitization of execution, it's becoming very difficult to actively outperform in the known names, right? Hence, at the beginning of the show, I said that, outperforming consistently in large cap category is becoming difficult. But when you go lower down the cap curve, right, there is enough possibility to exercise your skills and differentiate between good quality companies, bad quality companies, and be a little more nimble-footed to generate alpha. In the West, like I said, I mean, look at the numbers, right? We are 52 lakh crore industry today, but the better way to look at it is, I think the equity piece is about 15-16 lakh crores, if I'm not mistaken. Passive is already 2 lakh crores, which is not a small number. It's close to 13-14% of the, or more rather, of the overall equity AUM. And it'll grow because a lot of the institutional investors prefer to take, like EPFOs, etc., prefer to take participation in the market through the passive route. But for individual investors, right, large cap, it's a great idea to have the Nifty index or maybe the next Nifty index. But when it comes to mid caps, small caps, there is still a large possibility of outperforming the indices. But of course, you need to work with an advisor or a wealth manager who can help you select,
pick the right fund.
Pick the right funds. And more importantly, and I'm just adding this to this conversation, often what we do is we look at the last 3-5 year return and we say this is the best performing fund and hence let me allocate. Let me tell you, the rotation in terms of the ranks based on last 3 year returns changes extremely fast. So that's why you need a wealth manager to tell you who are the fund managers of funds which have consistently performed.
Sure, so you need to see through the cycles, like you're saying.
Stay through the cycle.
Got that, which is why, I mean, there's no straight answer. You have to have both a little bit of active and passive. We're going to continue this conversation on the other side and answer more questions exactly on this issue. How to bring the right balance in your portfolio. Back in a moment.
Let's talk money.